most hedge funds use a 4-point to a 6-point ES stop, okay, which in the equivalent of SPY is a 40 cents to a 60 cent stop, yeah,
Right.
Which is really at a 50 delta option that we buy, right, at the money.
Right.
It is really a 20 cent stop.
Right.
Now, why is that so profound? It is, I have to close your mic, they say, Fred. It's distracting. Okay? I'll put you back.
Yeah,
thanks, Fred. So anyway, 20 cent stops. Okay? It's 20 cent stops on your premium. Now, why is that very profound? Because look here on the ES. On the ES, 1 ES equal 5 contract at the money 50 delta SPY. But look what happened. On the ES, most people do 2-point stop. $100. But look at me, the beauty of me. 5 contract SPY, I do 20 cents stop. For the same amount of money, which I risk the same amount of money of $100. But look the beauty. My 20 cents is really the equivalent of a 4-point ES stops. So when you trade directionally the SPY, guys, you really have more leeway of breathing room than the ES. Do you guys catch it right now? Where is the trick with the delta? The trick is that most hedge funds trade at 4 points, but you, the retail traders, have no chance. So profound to trade so profound to trade the SPY versus the ES. Not only do you have the same risk of $100, but you have more leeway to be right on the SPY because this is the equivalent of 4-point ES. And the return on your money is 5 times to 300 times better than the ES. Okay? If you look this morning, compare Mark, SPY, 3 contract, 1 contract, 26% return. Second contract, 29% return. Third contract, break even plus 2 ticks, 99 cents. Compare that to the ES. The ES moved, let's say, from top to bottom 10 points, which is $500 divided by a $10,000 capital requirement. It's a 10% move. That's it. Same risk, you have 2.6 to 3 times more reward. And the risk that you take on the SPY is the same as the ES, yet it would take 4-point ES to move you to the 20 cent stop loss because of the 50% correlation on the delta. Not here. So first and foremost, you have to understand that this strategy needs to be a strategy with no overnights. Okay, it's a strategy with no overnights. It's a strategy you close all positions before 4 o'clock. 4, 4:30, 4, 4:15. I think it still go to 4:15 the SPY. Okay, that's it. It's an in and out with 5% to 10% of your account to create 50% or more and do as many safe doubles per year, okay, with small amounts of money at risk. Okay, that's the strategy. So number one, stop loss on the strategies we explained for an hour. It's 20 cents. At a 50 delta, it is the equivalent of a 4-point ES stop. Are we all clear on that? Clear? And it's going to be more clear because at least the pen doesn't erase. Yeah? Okay? So now, 2, we start by buying only one contract. To bait the price action, like I explained price action. Refer to price action daily analysis video. We talked about this all morning. How to bet that price earlier. 1. Then when confirmed, enter the rest of the position. Enter the rest of the position by tier. 1/3, 1/3, 1/3. Okay? Some of you who will trade always for the rest of their career, or will trade 10 contracts or less, can bet each bid to make sure that each levels make sense, each bid or mid price, not the ask price, to complete the order. So essentially, let's take a very pragmatic example of this morning. I was looking at the 27 ES to hold. I bet the bid on my option at 93 cents. There was a bid and ask, 93 cents, 94 cents. It took me. So I said, shit, it's going to go lower. It went lower. Then I try, and now it's going 94 cents by 95 cents. And I try to get 94 cents, and it doesn't fill me. So I go in the middle. Well, let's say it was 96 here. Go in the middle at 95. It doesn't want to fill me. So now I'm obliged to run after the order and throw a market order for 96 cents. And then I filled another one. So I had one contract here, one contract here. And you kind of tried around the day trading zone, see what happened around the bids and the mid price. And you finish filling your order. Soon as your order is filled, you have a 20 cents automated stop loss. Target, and you are systematic, guys. This is like, I told you, what makes our success, part of what makes our success is being automatic in everything we do. Automatic in everything that I do. I am completely like a robot, okay? You know, I use the DTZ analysis and interpretation, and you mix your creativity, but you need to be scripted on your blueprint. Number 4, the targets. Target 1, always take 10 cents to 20 cents for 50% to 66% of the size. I use only 50% of the size if I am pretty sure it's going to keep on going to the day trading zones, and the main trend and the main trend and intermediary trends are aligned. So 50% to 66% out, and let 50% to 33% run to next target, next DTZ target. That's it. 5, when price moved up at least 12 to 15 cents, move, break even plus 2 ticks. Quickly. So your winner doesn't become a loser. Okay? And that's it. You have nothing else to do in this strategy. It is a very important that you understand those steps. There's 5 steps. It's always the same. You don't need to be a rocket scientist. And that's it. So now the key now is to understand what day and what strikes and what delta. So 6. Monday, trade Monday, Tuesday, trade 50 delta. So you go on your option. What is a delta? Well, it's an option. It's the correlation between the move on the SPY and your premium. So it's a percentage correlation. If you have a 50 delta, if I look at this 183 puts, it means that each time the SPY moves 10 cents, this option is going to move 54% of that 10 cents, so 5.4 cents. Are we clear, everybody? Quick yes, no, so far? Yeah? Okay. So again, you look at 50 delta to trade. You look on the option chain. You have a bid and ask and an open interest and the probability in the money. The probability in the money is your delta. I could replace that by delta here. You know? It could be my delta right there. It's the same. You multiply by 10 by 100. That's your delta. 53, 0.53 or 0.52. So 52% correlation. Okay. So you look at your delta, and again, Monday, Tuesday, you trade 50 delta. Wednesday, Thursday, you trade 40 to 50 deltas. So you go one strike out. One strike out from the money. I like it. Ready? Okay? So you have your Monday, Tuesday. You have your Wednesday, Thursday to choose your strikes. And then Friday, 30 delta, because it's very risky. Very risky gambling trade that can provide quickly 50%, 100% ROI plus minus. you can lose. Okay, so this is in a nutshell the way I like. Now, see, I'm giving you everything, and I'm very pragmatic. We don't need to spend hours and hours talking about it. I'm giving you stuff that I do with real money that are not that complicated, but you need to know. And you need to trust that it's working with real money, because I know the perfect delta. I have tried for many, many years. Not trade next week options on Thursday and Friday when market is volatile. Because what will happen is, because the volatility will be so high on Thursday and Friday, that the option will crush very fast if there's a news that lower the volatility, and they'll blow up in your face. So we repeat again. I'm going to repeat quickly the 7 points or 6 points. First point, the S&P weekly strategies is a strategy that has no overnight, where you close all your position by 4:15 every day, with only 15 to 5 to 10% of your account to create 50% or more rate of returns, and to do so as many as possible doubles with small amounts of money and amount at risk. Here. The point number 1 of this strategy is you take a 20 cents stop loss at a 50 delta, which is the equivalent of a 4-point drop up and down on the ES. We start by buying only the contract to bet, the price action to the bid or to the mid price to refer to price action daily analysis video like we explained this morning, and see how it's being done with our pre-market analysis and your day trading zones daily analysis on the SPY, ES, and Google and Apple. Then, when confirmed, enter the rest of the position by third or enter everything else. Okay? I exit by third for sure. Some of you will trade 10 contracts or less. You can bet each bid a contract at the time to test the tape to complete the order. And the beauty of this is a lot of traders, they enter all in. They enter 10 contracts. And suddenly it drops 10 cents, they just lost $100. Well, if you had enter and bet on the bid one contract and you know it's dropping 10 cents, you only lost 10 bucks. And then you can buy even lower. So betting is a good idea. It's a good thing that works for you. Target always at the first 10 and 20 cents, move toward your direction. Take 50 to 60% of the size, 50% if you think that it'll continue going up, 66% if you think there's a high probability we are approaching important resistance, let 50 to 33% runner to the next day trading zone target. Then next, you need to understand when the price move up at least 12 to 15 cents move, okay, you move your break even to 2 ticks. It could be 10 cents, guys, really. I think that really when you start making 8 cents, actually because you are new, I would say 8 cents, and I'm going to tie that to 12 cents. When you have your price moving 8 to 12 cents, tie it up to break even plus 2 ticks. Because you have to let it breathe a little bit, okay? Then on Monday, Tuesday, always look for 50 delta in your option chain. Wednesday, Thursday, 40 to 50 delta. One strikeout velocity of the delta if you are wrong. It doesn't blow up in your face. On Friday, 30% delta. It's a very risky gambling trade that I do on option expiration. They can provide you a quick 50 to 100%. Oh, another trick, buy them on Friday at between 55 cents and 75 cents top, maximum. Do not buy more than that. That's why they are dirt cheap. And then note that if the volatility on the Thursday and Friday of the markets are high, do not trade the current week, trade the next week. So trade next week options on Thursday and Friday when market is volatile and crazy. Okay? So now, do you guys have some question and answer? Is that pretty clear? Okay, is that pretty clear, guys? Quick yes, no. You know, you'll have to practice this. It'll take time. You know, this is all about repetition. It is all about doing it again and again every day. I recommend you, if we were to do a 0.7, I would do it like this. Simulate the strategy with 2 contracts or 3 for the tier for 4 to 6 weeks using your entry and exit sheet. Entry exit sheet provided to you to track your matrix properly. That's it. And then go live. Then go live. Real money, assuming you know your trading platform well. Otherwise, be on the sim also for your trading platform well. And your chart platform and your DTZ. And your chart platforms with the DTZs. Zones. Okay? The SPY blueprint. You start in the morning, everyone, and you need to do your analysis for your between 6 and 7 a.m. on your ES, the YM, the NQ, the SPY. You need to look and create your buy zone, sell zone, and caution zone for those 3 or 4. You look for spaces that make sense on those 3 and see if they are all retesting like I just showed you earlier, caution zone or buy zone or sell zone, so you have synergies between all those indexes. Make sure there is at least 50 cents of space. More than 50 cents, it's even better between the support and the resistance. 50 cents to $1, $1.20, because if we buy 50 delta to 70 delta, we want to make sure we can make at least 25 cents on the options. On the target 2, on target 1, you'll find if you take 10 or 15 cents. Then on Monday, you look for 75 to 70 deltas because the time decay doesn't decay as fast. On Wednesday and Thursday, but on Wednesday, we are looking at the money, which is a 50, 59 delta. On Thursday and Friday, we are looking at one strike out of the money, which usually are 45, 50 deltas. And if there's a big move in the market, and the market is nervous like yesterday and today on a Thursday or on a Friday, then go start trading for the day next week options. Like I took next week options. Unfortunately, when you do that is A, the weekly options are cheaper. B, the return on investment on the weeklies are higher. As you've seen this morning, we compare a 100% return compared to a 35, 40% return. B, C, cheaper ROI. C, the capital requirement is less on the weekly, but the problem is they jump a lot more. So they make you more nervous quickly, and they jump more to get your 20 cent stop loss. Okay? You start the trade, you place a bet on the bid, whether you buy a put or a call. You place the trade on the bid, so you see if they take you. If they take you on the bid like the market maker, you know they will drop the price, and your support is not yet achieved with a shift of momentum. If they do not take your bid and keep on doing higher bid, then it means that your assumption that there's a strong support around that zone or that recross is strong. Then you enter your trade with the rest of 66% of your size. But initially, you can enter 33% of your size or 1 or 2 contracts just to put that fish in the ocean to bet the tape like I have showed you. This is in a nutshell the SPY blueprint. And by the way, if you like a theme like SPX going down or up, overlay one this week and one next in 2 weeks or next week and the month after. Me, I like them like this. 3-4 days out, right? Tuesday, Wednesday. I like them next week, which is 7 to 10 days out. And then I like them 30 to 60 days out. Yeah? Well, if you have a theme, you have a position here, position here, position here, but guess what? You focus on watching only one graph. That's very important.